We are going to go ahead and get started. If everybody wants to grab a cookie and some coffee and take a seat. Welcome to Bartlett's annual market review and outlook event, Navigating the Noise. My name is Kelly Downing, and I am President and CEO of Bartlett. We take this opportunity to provide you our insights about the markets, which have been pretty volatile recently, and also to give you some time to meet with our various investment advisors and some of the support staff here at Bartlett. People tell us that they value and appreciate the continuity of service that we provide our clients. And we have long-tenured investment advisors who've done this for many, many years. In fact, on average, 22 years, so long-tenured employees here. I came to Bartlett almost 20 years ago because of the high regard that I held for these advisors. Many of you already know them or work with some of these investment advisors, and I'd like them to stand as I call their names. Jim Miller, Mike Cameron, Rick Reynolds, Woody Ubel, Terry Kelly, Jim Haggerty, Ken Schlachter, Troy Snyder, and Dave Francis. Thanks. Yes, they all deserve that hand, but there's more to come. Over the years, we have formalized our financial planning practice with expert CFP advisors. And what they have done for many of you, but probably not all of you in this room, is develop complex financial plans. Two of those CFP advisors are with us today, Laura Humphrey and Lori Poole. And we've also hired, over the last several years, that next generation of advisors and support staff, some of whom you've met today already. They help us achieve and maintain that continuity of service as we match up our client demographics. And they also bring new expertise and enhance our ability to expand those client services and offerings for you. That next generation of Bartlett advisors and leaders are Kyle Pullman, Brian Antonucci, Craig Sarenbach, Chris Robbins, and Holly Hurt. And other representatives from Bartlett who you probably saw out at check-in today are our client relationship associates, Lisa Smith, Teresa Manarino, and Courtney Augsbach. They may still be out there, right? Okay, so they're still out there. We're clapping for you guys. Also with us today is Kelly Muthert, our Director of Human Resources. And lastly, I would like to thank Catherine Miller, our Client Communications Associate, and Lisa Smith, who was also our Marketing Associate, who provided significant support for today's presentation. So thank you very much, Catherine. So, navigating the noise. What do we mean by that? We live in a world of too many sources of news spewing out way too much information that may or may not be reliable. National publications, talking heads on TV and radio like Kramer, Morning Joe, and Squawk Box that you all see every morning are just causing way too much noise. Sensationalism, political viewpoints, and cyclical references are intended really to grab our attention naturally, and in many cases cause fear over dramatic near-term events. Emotions drive behavior that is oftentimes not in our client's best interest. So our job in this fast-paced, internet-connected world is to separate the wheat from the chaff. Today's presentation is all about this noise, and what we at Bartlett do to distill the data objectively in our clients' best interest in the decisions that we make. At each of your chairs today, you'll see that there's a folder. And in this folder, there's information with the slides that go along with the presentation, bios of the presenters, and other information about Bartlett. With that, I would like to introduce Woody Ubel. Woody has been a senior investment advisor at Bartlett for over 35 years. He is manager of the equity strategy and a principal at Bartlett. Woody will present our recap of the 2015 markets and get a presentation started.
When we begin preparing a market outlook, we typically start with trying to understand where markets have been and where markets are today. Trends are very important in regards to financial markets because trends tend to be persistent. In the investment world, we call this the momentum effect, which means that markets and individual stocks and bonds will frequently move in one direction for longer than many investors expect. One of the major themes that you will be hearing from us today is that this economic and stock market trend, which has now been rising for nearly 7 years, is beginning to age. It's slowing down, losing some vigor, and as a result, we at Bartlett are becoming more attentive to a trend change and have already begun moderating the risk within our portfolios. Our investment teams have been preparing these outlooks, these forecasts for the last 3 years. So we thought it would be a good time to step back and look at our scorecard and ask the question that might be on many of your minds, which is just how have these Bartlett folks been doing? What better way to communicate these emotions, these opinions about our happiness and disappointments than with emojis? Overall, we are pleased with our asset allocation recommendations over the last 2 years. Going into 2014, we took an overweighted stance with regard to U.S. equities, which proved to be the right call because U.S. stocks, the S&P 500, rose over 13% that year. Last year, we went to a neutral stance on U.S. stocks, which also proved to be the right call because stocks leveled off last year. And in the face of widespread anxiety or noise regarding the prospect of higher interest rates, we maintained our commitments to fixed income over the last 2 years, and that also proved helpful to our clients. Alternative investments in the minimizing of cash also proved to be the right decision for our client portfolios. We all get bombarded with news, again, noise regarding economic and financial information. At Bartlett, we can't always predict, but we can explain and frame these issues within the context of what is relevant to your investment goals. Among the many issues distracting investors over the last year, we see 3 at the top which have had an outsized influence on market volatility in 2015, which we see continuing into 2016. First, China. China is a very large part of global economic growth. In recent years, it has been estimated to account for between 1/3 and 1/2 of all global economic growth. Larry Summers, ex-U.S. Treasury Secretary, recently pointed out that between 2011 and 2013, China poured more concrete and cement than the U.S. did in the whole 20th century. Unfortunately, the inner workings of this huge managed economy are fairly murky. Massive interference with traditional free market forces like supply and demand, bankruptcies, the trading of securities has certainly shown its limitations recently, and we've also seen some of the market panics that can result. The trend for China will eventually improve, but it could take a while. We expect continued uncertainty and volatility coming from China. Oil. A year ago, when oil was at $51 a barrel, the general consensus view was that lower oil prices equated to a tax cut for consumers and would have a stimulating effect on the economy. Now, with oil drifting under $30 a barrel, it appears it hasn't quite worked out that way. Households just haven't been inclined to spend these savings. Meanwhile, the lower oil prices have resulted in the loss of jobs and business activity within oil-related businesses. And all of this has had a depressing effect on the overall economy. We believe that it is very likely in 2016 that less supply and more demand for oil will result in a recovery of oil prices and oil-related businesses. And at the same time, consumers should begin to start to spend these savings that have resulted from the lower oil prices. The dollar. The strong dollar has definitely taken some wind out of the sails of the U.S. economy. However, there is a benefit for foreign economies because their businesses can become more competitive on price because of their lower currency value. So the strong dollar, although it weakens the U.S. economy, strengthens foreign businesses, which over the long term should benefit everyone. In summary, movements in the value of the dollar and the price of oil will continue to move markets this year. However, they are not a longer-term concern. China is, however, mysterious and concerning and will continue to be the major market influencer in 2016. Let's take a look at how the economy performed in 2015. As you can see, it was pretty much a continuation of 2014. Low inflation, continued improvement on the employment front, and consistent with our less bullish outlook a year ago, a little weakness in GDP growth. One material change was a significant drop-off in corporate profits, again related to those oil and dollar issues I just mentioned. When we shift over to look at the capital market returns, you can see some linkage from these economic statistics we just saw. Generally, pretty anemic returns across the board. The market tended to favor large U.S. companies, and as you can see, small companies, as represented by the Russell 2000 index, were down a little, and foreign stocks within developed countries were just down slightly. Some people actually are beginning to question what kind of market this is. It doesn't currently feel like a bull market, and yet we're not in a bear market. Someone recently pointed out that this is a hippopotamus market. Well, hippos are large animals that tend to move forward at a slow pace and are prone to occasional outbursts of violence, or volatility as we call it in our business. These overall market performance figures are a little deceiving. Most investors didn't do as well as the S&P 500 because a few large, high-priced tech stocks, namely Facebook, Amazon, Netflix, and Google, also referred to by the acronym FANG, accounted for much of the good results in the market. When taking these four out, the other 496 companies in the S&P 500 had a total return of a negative 1.4%. And when you look at the indices, including some mid-sized companies and those with value mainstream characteristics, stocks were typically down from 3 to 5%. This narrowing of the market bears some attention, and Terry's going to talk about this more in a few minutes. So what are the likely key drivers of performance in 2016? First of all, We need continuation and, more importantly, improvement of the global economy for stocks to break out of this lethargic hippo market. The U.S. economy is increasingly reliant on foreign trade. About 25 years ago, 4% of our economy was related to global business activity. Today, that's about 16%. And there are other linkages that suggest that foreign trade is very important to U.S. business. This is a challenge because the world economy is still digging out of the debt woes that came to a head 7 or 8 years ago. We believe that decent prospects for global growth are more likely in 2017, so we continue to have modest return expectations going forward in 2016. Secondly, the modest growth pace of the U.S. economy has kept excesses such as inflation and manufacturing shortages from developing, and these are the typical conditions that precede a recession. This would suggest a slow pace of federal interest rate increases, which would help prolong the economic recovery. Third, this is becoming one of the longest economic and stock market uptrends in nearly 100 years. We believe there's still adequate runway for the economy to continue growing, but we need to be vigilant. In summary, we are staying the course with our asset allocation positions, but believe that moderating portfolio risk within the stock and bond components of our client portfolios is appropriate at this time. In a moment, Chris and Terry will talk about how we are implementing this risk management. Our next speaker is Chris Robbins. Chris is one of our fixed income advisors and has 9 years of experience in the investment business. We were thrilled when we drafted Chris onto the Bartlett team in 2012, and we knew he had great ball handling skills and could provide some assists. And he can also dribble, rebound, and score, and has become a very important player on our exemplary fixed income investment team. Chris?
Some of you might be wondering, what is fixed income? What does that mean? Fixed income is simply investment speak for bonds and bond-like investments. There are 3 things we'd like to cover with regard to the fixed income markets. First, we'll talk about the role that bonds play in your investment portfolio and why we like to own them. Next, we'll discuss the state of the bond market and highlight some recent developments that are noteworthy. And finally, we'll cover some specific areas of investment opportunity that we're seeing right now within the bond market. Bonds can be thought of as the cornerstone of a conservative investment portfolio. The first role of bonds is to generate a steady, consistent stream of income. Now, when we're constructing any portfolio, we think about total return, we think about income, but always within the context of what risks we're taking. And the second role of bonds, and the most important role, is to help manage risk and to serve as a shock absorber in down markets. To illustrate this, we took a look at the returns, the monthly returns of both stocks and bonds from 1926 to present. In any given month, one of 3 things could be happening. Both stocks and bonds could be moving up in value at the same time, highlighted by the blue portion of the chart. They could be doing different things, with one moving up in value and the other decreasing in value, or they could both be decreasing in value at the same time. The important thing to notice here is that it's relatively rare that both stocks and bonds decrease in value at the same time. It's happened only 14% of the time. Many of you remember the financial crisis of 2008. Things started to get ugly for the equity markets about September 1st of that year. By March 9th, 2009, the equity market had bottomed out, and the S&P 500 was down 46.5%. During that same time frame, the Barclays Aggregate Bond Index was up in value just under 2%. So that's a recent real-life example of how bonds were able to minimize volatility during a time of turmoil in the markets. Now, let's talk about the state of the bond market. It's difficult to talk about the state of the bond market without mentioning the Federal Reserve's recent decision to raise short-term interest rates. There's been no shortage of noise, no shortage of opinion surrounding this, so what really matters? First, what actually happened? The Federal Reserve, our monetary policy authority in the United States, in December raised the range of its benchmark interest rate 0.25%. Since the financial crisis, the Fed has been very accommodative, and they've been doing things designed to stabilize markets and stimulate the economy. And the fact that they're raising short-term interest rates simply means that they're officially taking their foot off the gas and taking a step back. This chart shows where the Fed funds rate has been over the past few years, highlighted by the red portion of the chart. As you can see, it's been close to zero and hasn't moved. The blue line shows where the Federal Reserve expects this rate to be over the coming few years. And the yellow line shows where the market expects the same rate to be over the next few years. One thing that's apparent here is the yellow line is below the blue line. And what that means is the market is skeptical on how quickly the Fed will be able to raise interest rates based on prevailing market conditions. And the other thing that should be clear is that both the Federal Reserve and the market expect a series of small incremental interest rate increases as opposed to one or two abrupt interest rate increases. Our view is that slow incremental increases are better for the market than abrupt interest rate increases. So that's important to notice. Now, let's talk about some of the noise that's out there surrounding this. Many of you might have heard a statement, as I have, that goes something like this. Bond prices are inversely related to interest rates. Therefore, the fact that the Fed is raising interest rates is bad for bonds, right? Well, the first part of that statement is true. Bond prices are inversely related to interest rates. The second part of that statement is not necessarily true. It's important to differentiate between short-term interest rates and long-term interest rates. The chart behind me shows interest rates on U.S. Treasury bonds from 1 month out to 10 years. It's important to know that very short-term interest rates are driven by the Fed. The Fed funds rate governs overnight lending. It's a very short-term interest rate. Longer-term interest rates tend to be driven by supply and demand, expectations on economic growth and inflation. And so while the Fed is raising short-term interest rates, that doesn't necessarily mean that interest rates will be affected in other places where a bond portfolio is likely to be invested. Now, this isn't the first time that the Fed has raised interest rates. So let's take a look back and see what has happened to a bond portfolio the last 3 times the Fed has raised interest rates. We took a look at total returns on the Barclays Aggregate Bond Index during the hike period, 6 months after the hike period ended, and a year after interest rate hikes ceased. For the past 3 times, the Fed has raised short-term interest rates. So starting back in 1994, the Fed started raising interest rates in January of that year and finished in February of the following year. It was a really volatile time period for the bond market, and you had periods of time in that year where you did have negative returns on bonds. However, when it was all said and done and the hikes were over, you had flat returns on a bond portfolio during the hike period. 6 months after that, you had very reasonable returns, and 12 months after that, you had fairly robust returns for a bond portfolio. In 1999, it was a similar story. During the hike period, you had relatively subdued returns for bonds. 6 months afterward, you had higher returns, and 12 months afterward, you had very reasonable returns for bonds. And then in 2004, you had moderate returns on a bond portfolio for all 3 time periods. The bottom line here is that even though the Fed is raising interest rates, it doesn't necessarily mean that that will have a negative impact on the bond portion of your investment portfolio. Now, another piece of noise that's out there right now surrounding interest rates is okay, interest rates in general are so low right now, they have nowhere to go but up. When you look at where things stand in the United States in terms of interest rates, yes, interest rates are quite low from a historical perspective. But compared to the rest of the world right now, our interest rates here are actually not that low. This is a chart of yields on 10-year government bonds for the United States and other developed market nations. I have to say this chart is a little bit dated. The yield on our 10-year government bond is closer to 2% now, but you can see that our yields are much higher than the other countries listed on the screen. So if you're an investor or a manager of a pension fund or some person who has to allocate capital in one of these developed markets, which bond would you choose? The fact that our interest rates are higher here is creating foreign demand for our bonds. That has a couple of implications. It's one of the reasons our dollar has been so strong, but it also can have the effect of supporting prices, keeping prices from going too low and keeping yields from going too high in some cases. But the takeaway here is that from a historical perspective, yes, our yields are low, but they're actually relatively attractive when you look other places in the world. As an interesting anecdote, this differential is even more pronounced on the shorter end for shorter maturities. So if you have a bank account in Germany or Switzerland, chances are you're paying the bank interest as opposed to the bank paying you interest, which is interesting. Finally, we'd like to talk about some opportunities, some investment opportunities in the fixed income market right now. The first worth mentioning are Treasury inflation protected securities, or TIPS. These are high quality government bonds issued by the US Treasury whose principal amounts and coupon payments are tied to the rate of inflation. Bartlett's view is that inflation expectations in the market are too low. For example, a 10-year TIP is pricing in inflation of about 1.3% over the next 10 years. Historically, that's been closer to 2%, and our policymakers would like to see that closer to 2%. So if inflation increases, we'll receive a benefit from owning TIPS. There's another way that TIPS can work. I have an analogy to describe it. I have 3 small children. They're too young to have cell phones, but does anybody in the room have kids who have cell phones? So I'm told as a parent that gives you a tremendous amount of disciplinary leverage over their behavior because you can take away the cell phone. Now, you don't actually have to take away the cell phone for that to work. They just have to believe that you might take away the cell phone. So that perception influences their behavior. The pricing of TIPS is based on what the market believes inflation will be. And so if we own TIPS and we don't actually get inflation, but the market starts to believe that we will get more inflation, that belief will be reflected in the pricing of TIPS. And so we can receive a benefit if the market simply believes we will get more inflation. The next area of opportunity worth mentioning in the fixed income markets are preferred stocks. Preferred stocks can be thought of as a hybrid between a traditional stock and a traditional bond. The important thing to know about preferred stocks is that they tend to do well when long-term interest rates are either stable or declining. The economic environment we're in right now will allow certain preferred stocks to add value as a tactical position within a broader fixed income portfolio. And finally, corporate bonds. High-quality corporate bonds have the ability to add value in a traditional bond portfolio right now. And what's interesting about corporate bonds is that even for our clients who are in high tax brackets and who are used to buying municipal bonds for their tax-free yields, in some cases, when we're comparing a tax-free municipal bond to a taxable corporate bond of the same credit quality, when we're subtracting out the amount of tax that client will have to pay for owning the corporate bond, in some cases, the corporate bond is more attractive than the municipal bond. That's a dynamic that doesn't happen all the time, but it's one that's unique to the environment we're in right now, and that's something we're taking advantage of for some clients when it makes sense. In summary, bonds will continue adding value to your investment portfolio, providing income and managing risk, regardless of what the Fed is doing. This is a dynamic market we're in, and it's presenting unique and interesting investment opportunities within fixed income. And finally, We want you to know that our team here at Bartlett has a tremendous depth of expertise when it comes to this important part of investment portfolios. With that, I'll turn it over to Terry Kelly. Terry is a principal and investment advisor. He has 33 years of investment experience, is a manager of Bartlett's equity strategies, and serves on Bartlett's executive committee.
Stock market lore is filled with sayings that are so often repeated that they are taken as certainties, when in fact most of these sayings are simply noise. Currently, one of those glib phrases we hear is "don't fight the Fed," which implies that the stock market may struggle given the most recent Fed policy shift. But let's look beyond the noise. This table shows the dates when the Fed implemented a gradual rate hike policy and the stock market returns 1 year later. As you can see, for the periods when the pace was slow and gradual, the average return 1 year later for the stock market was a nice healthy 10.8%. On the contrary, when the pace was fast, the average return 1 year later was a negative 2.7%. As an example, in 1994, the Fed hiked interest rates in a series of 5 rapid increases totaling 2.5%. The market subsequently fell 7%. The Fed was responding to, at that time, an accelerating economy and rapidly rising inflation, and these are conditions that simply do not exist today. The Fed has repeatedly said that the pace of rate hikes will be gradual and measured. And we take the Fed at their word, although they may be announcing something here as we speak. For 2016, we expect the pace of hikes to be slow, and we do not expect that the Fed tightening alone will undermine the equity markets. But interest rates are not the only factor to consider. Stock market performance is strongly tied to economic performance. An excellent measure of economic strength and weakness is the Conference Board's Index of Leading Economic Indicators. The blue line in this chart shows the growth of the leading economic indicators over time dating back to the late 1950s. The gray shaded bars denote economic recessions. As illustrated by this graph, over time, recessions do not occur until the LEI has turned down. On average, these occur about 1 year in advance of the recession. The red circles capture these periods where the index peaked and rolled over. Although the index is yet to turn, there are some elements within that, particularly stock market returns recently and the downturn in manufacturing activity, that have begun to soften. The combination of the softening and the change in the direction of interest rates have raised our level of concern towards equities for 2016. Let's look beyond the economic data and examine 8 stock market factors that collectively appear at major market tops. Most of you recall the market tops in 2000, the tech bubble, if you will, and the peak reached in 2007, shortly before the financial crisis. In each instance, all 8 indicators were present. Last January, only 2 had appeared. Now 5 are present. That alone does not bring us to forecast a bear market, which is widely defined as a decline of 20% or more. However, the 3 new indicators are cause for concern. The first, weakening upward earnings revision, typically signifies that stock price momentum will slow as management teams and Wall Street analysts begin to forecast weaker results. We noticed the slowing in these upward revisions in late 2015, and we expect more of the same from some cyclical industries as we enter 2016. We also saw an erosion in the number of stocks making new highs in 2015. As Woody pointed out earlier, equity markets equity market returns were very narrow in 2015. A few large companies with strong upward momentum drove the index higher to higher returns, but the average stock was actually negative for the year. While much of the negative activity in the junk bond market, the third addition to the list in 2016 is a widening of credit spreads, particularly in the junk or high yield market. There's a strong historical relationship between rising junk yields and rising equity volatility. We regard this factor as a potential canary in the coal mine. While much of the negative activity in the junk bond market has centered around energy companies, if this were to spread, or the sentiment were to spread to other areas of the high yield market, it would be an additional cause for concern. Together, these additional factors increase our cautious stance towards U.S. equities for 2016. But we do not believe we are in bubble territory. What this means for Bartlett clients is that we are not avoiding risk, but we are, in fact, focusing on managing risk, and this is taking place through stock selection that's based on visible fundamentals and what we would consider reasonable relative valuations. Much of the noise we hear from commentators centers on stock market valuations measured generally by price-earnings ratios, or PEs. The blue line in this chart illustrates the trailing 12-month PE for the S&P 500 spanning 60 years. The red line is the average of that PE for that period. The bubble years of 2000 and 2007 are evident as they strayed well above the average. There's a strong relationship between interest rates and inflation. Low interest rates and low inflations will, in general, support higher PEs. Now, given the still accommodative central bank policy resulting in low interest rates that Chris and Woody have commented on, and the low inflation environment that we find ourselves in today, stock market valuations remain within the strike zone that are illustrated by the dotted lines on this chart. Today, the market PE is close to the long-run average, but certainly not at levels present at market tops. Should we start to see the PE rise to uncomfortable territory suggesting a relative overvaluation, it would be a cause for concern. However, at today's levels, with relatively low inflation and low interest rates, it is our judgment that valuations are reasonable. So far, we focused our comments on the domestic equity markets. Over the years, Bartlett has encouraged clients to invest in non-U.S. equities for valuable diversification and certainly potential attractive returns. We continue that recommendation in 2016. Comparing the major market indexes, the S&P 500 for U.S. stocks and the MSCI EAFE for international stocks, you can see in this table that domestic stocks and the developed international stocks trade places in relative valuation over time. At times, these shifts can last for long periods of time. As an example, over the last 6 years, the S&P 500 has delivered about 112% of excess return over the comparable index or the EAFE index. But there are three major reasons why we believe this trend may be changing. The first is central bank policy. The European Central Bank, or the ECB, is in the early stages of easing, very similar to the action we've seen the Federal Reserve, but yet a few years behind the Federal Reserve action that we've seen over the last several years. As the Fed is now starting to raise interest rates, the ECB is actually keeping their foot on the gas and adding stimulus. The second is a weak currency. Since early 2014, we have seen a weakening of the euro and other major currencies against the United States dollar. This currency shift, as an example, effectively makes European goods cheaper than they were in the past against their American counterparts. The shift in relative price it makes goods of European companies much more attractive in the global marketplace, thus helping to boost their sales and exports. And the final reason is relative valuation. Many of the international stock markets are priced at attractive valuations relative to the U.S. and on a historical basis. Now, we acknowledge there are current risks that can impact international stock markets, including the political and economic impact of the refugee crises, the ongoing threat of global terrorism, and perhaps the underestimation of the growth of the world's second largest economy, China. But given these concerns, we suggest utilizing diversified mutual funds favoring developed markets, perhaps leaning towards the consumer. Our expectation for international markets in 2016 is for a beginning of improved relative valuation. So how do we navigate the noise in the equity markets? First and foremost, we start with a focus on risk management by investing in a fully diversified portfolio. A typical Bartlett portfolio will feature 25 to 40 high-quality U.S. large-cap names, supplemented with top-flight mutual funds for the other equity asset classes, mid, small, and certainly international. And we currently favor stocks of companies with high-quality financial fundamentals, sustainable competitive advantages, and reasonable relative valuations. We believe stocks in defensive industries will fare better in 2016 than stocks in cyclical industries. Healthcare, consumer, staple, and some technology stocks are defensive sectors with lower risk that we expect to post solid returns in 2016. We continue to like international equities, especially developed markets, which will benefit from the monetary easing we mentioned and certainly the relative modest valuations. In summary, it's been a rocky start to 2016, but the data suggests that opportunities are attractive for both domestic and international markets for patient investors. So far, our comments today, we've discussed the opportunities we see in 2016, obviously for stocks and bonds. The common thing we have covered is a focus on risk management. Alternative investments are an additional risk management tool that we employ in client portfolios where appropriate. Our suggestion is to include alternatives to help offset some of the risk we see in the stock and bond markets. To be added to any investment portfolio, alternatives must have a price and return trend that is different than traditional stocks and bonds. The desired result is an offset to downside price movement in stocks and bonds. Bartlett's recommendation is to select mutual funds within the asset class that provide liquidity, relatively low cost, and a simplified tax reporting structure. This slide shows a recent period when, where alternative investments delivered on the previously mentioned requirements. Last summer, from July 20th through August 25th, the U.S. stock market suffered its first correction, if you will, of more than 10% in 4 years. As you can see, the S&P fell 12% in that 1 month alone. Bartlett's alternative model, which included hedge funds, managed futures, and insurance-linked securities, delivered a positive return for the period. Alternatives can offer an additional risk management tool, particularly during periods of significant equity declines. They're, in fact, protection when you need it. Long-term investment success is the result of discipline, planning, and avoiding emotional penalties. Bartlett has long encouraged clients to develop a dynamic investment policy statement that includes elements to ensure the discipline is integrated with their financial plans and helps control behavior driven by emotions. Asset allocation ranges and targets form the backbone of any investment policy statement. Determining the appropriate allocation targets takes into consideration long-term objectives, risk tolerance, and certainly the prevailing capital market conditions. This table shows Bartlett's guide for asset allocation going forward. Given our focus on managing risk in 2016, we are recommending rebalancing portfolios to prescribed targets. For example, a policy that sets the allocation at perhaps 60% stocks, 30% bonds, 5% alternatives, and 5% cash, but have now either allocated above or below those targets, should adjust the weightings in each of those asset classes. Equity returns over the last several years have likely moved the stock allocation above target. Reducing stocks and increasing or one or all of the remaining asset classes is a disciplined and non-emotional way to manage risk. For 2016, we believe this strategy will be the most effective way to navigate the noise. This concludes our formal remarks. I'm going to ask Kelly and our other speakers to join me, and we'll answer your questions.
So we have Courtney in the back and Teresa on this side in the back with microphones. So if you'd raise your hand to ask a question, they'll come over. It's a big room, and so we want everybody to be able to hear your questions. So we've got one up front. Wait for the mic.
Hi. What's going to be the driver to kick in the international markets?
Well, good question. So the international markets, pardon? The question is, the international markets, what will be the driver that kicks in the international markets that Terry was talking about?
Well, at least it's our view that it's going to begin in the developed markets where they seem to be ahead of the emerging markets in terms of repairing their economies. I'll use the Eurozone as the best example. We mentioned that they have been easing now, and they are continuing to ease, rebuild capital in their banks, and see improvement in their economy. Obviously, one of the big linchpins is what Woody had mentioned in his remarks, and that's China, because many of the international markets, particularly the emerging markets, are essentially tied to China's economic activity. They're a big trading partner of them, more so than the United States. So a turnaround, I think, there. Although it's interesting to note, I think our view is that the world has been reacting more to what's going on in the Chinese stock market as opposed to the economy. Again, 6% annual growth is something we'd be doing cartwheels here in the United States. And there is a transition going on there. So as that gradually repairs, we think that'll also be a boost for the international markets. But the monetary easing, and right now there is an advantage to many international markets in their currency versus the US dollar. It makes them far more competitive. So we expect as we look forward, that's going to result in better results in their equity markets.
In the back. Teresa's coming over.
Thank you, Teresa. In line with your theme about navigating the noise, you haven't mentioned anything about the political campaigns this year and the national elections. It seems like I know that there are historical trends on what that does to the marketplace, but this is a especially kind of crazy year with the polarization of the candidates and the parties. So what do you think effects that might have on the stock market and on Bartlett's investment strategies?
Good question. We probably don't have the ultimate answer, but we do have some thoughts about that, and I think Woody would like to start with that.
Well, we take a very long-term view, so it would go beyond, the vagaries of what the outcomes of this election would be. We're sort of agnostic on that. Historically, in the four-year election cycle, the year of the election is the second best performing of that four-year period. So that would suggest maybe things might get a little bit better from here on through the end of the year. But we really actually don't factor it into our investment strategy.
I know there's other questions up front.
Somewhat similar question to the previous one. Terrorism is a big factor in most people's thinking today. all across the globe. And it does not appear, at least to this person, that we have, or anybody has, much of an effective strategy to deal with terrorism now or going forward, which would lead me to expect that it would get worse. And that surely will have some impact on investments. What's your reaction to that?
So I'll summarize that question by saying that terrorism has unknown impacts at this point. But the question is, how do we factor things like terrorism or politics into our portfolios at Bartlett, and what impact that might have on any markets as well?
I think I can address that a little bit in most recent instances, what we've observed. The one that comes to mind that probably caught everybody's attention was the incident in Paris. And what we've observed is it does have some sort of short-term impact on some businesses that are either near or around the target. As an example, I know that in this recent quarter, Starbucks, which is not a company that we own, but we did catch their mention that the terrorist act actually had a depressing effect on sales in France and in Paris. So our observation is it's too hard to predict these, obviously. It's impossible to predict them. But the impact on global markets tend to be fairly short-lived. If anything, there's a rise in fear, so you'll see a rush to high-quality bonds as an example, or perhaps to the metals, but that doesn't seem to be persistent. It can be disruptive in terms of growth and the momentum of growth, particularly in Europe, which tends to be a little bit more exposed than we are here in the United States. Although it's always in the headlines, we have the advantage of being surrounded by oceans, whereas there has been a tremendous amount of I guess, refugee traffic and a lot of immigration from the troubled areas in the Mideast. That's causing some angst, if you will. So it goes beyond just the terroristic act. It's probably the follow-on. But when we look at it from what we do within portfolios, again, we're looking at companies that we think are, and when I'm talking about stocks, well-financed and generally able to withstand most short-term storms like that, if you will. Does that answer your question, or even get close to it? Agreed, but what I should mean by that is, again, we're not having the immigrants flow in like they are in Europe. I should clarify that. It doesn't give us any great distinct advantage. It just is distance, but it doesn't. There's no sure, foolproof way of avoiding terrorism. Obviously, it could happen any day, any moment.
Teresa, over here in the middle. Who had their hand up? Right here? No. Next table, right here. There you go.
Thank you. With the opening of markets, supposedly, in Iran and in Cuba, what effect do you expect those two countries to have in the global marketplace?
So the question was, with the opening of markets in Iran, and I didn't hear the other, in Cuba, what do we expect to see?
Well, there's probably going to be some dislocations based on what industries you're talking about, how they could be affected, but long term it's got to be a big positive. One of the headwinds for the whole global economy is this aging of the population and the lack of population growth. And so basically some of these countries are off the economic grid, or have been, so bringing them into the kind of capitalist type markets should over time create more business opportunities. But this is more of a longer term. It's probably not, you can't measure this in 1, 2, or 3 years. It's probably more like 5, 10, or 20 years, but it should be a positive.
Well, it turns out that right now, I understand Iran is running around the European countries, spending its 100 billion plus that the administration is or has already given to them. It's got to have some effect.
Well, that hopefully should be positive. I mean, if the European economy starts to pick up incrementally as a result of that business activity, it all kind of links back to our economy. We sell into those companies. And you can take sort of a political stance on it about whether that's right that Iran is doing the business, but over time it should be good for economics and markets, we think. Well, it's kind of hard to say. I don't know the nature of these contracts, but it's probably nothing that's going to happen this year, but maybe beyond 2017 we could start to see the impact.
I'm sure you're familiar with Robert Gordon, whose latest book is just out. I think maybe his point of view could be summarized as the best is behind us in terms of innovation and growth, that we won't ever see again in the United States the level of growth that we saw at the end of the 19th century and the beginning of the 20th century. I wonder what you think of his point of view, and if he's right, how might that affect, or should that affect, investment strategies and your sense that valuations are reasonable today?
So the question is the best behind us? We would hope not. So how does that impact economies going forward and our projections about markets, and what do we see over more the medium to longer term?
First, I have not read the book, so I can't comment directly on that, but I get the gist of it. I'm reminded that just before John Templeton died, he reminded us all that about 90% of the innovations of all mankind took place in the previous 50 years, up to the time that Sir John died. So the rapid pace of innovation has been recent. To judge when it ends is obviously a guess. With respect to investment and with respect to valuations, obviously a constant, I guess, discussion that we have about valuations is relating it to the level of growth, among other things. I mentioned interest rates and inflation, but the actual ability for a company to grow sales and earnings. I think it's a very long standard for Bartlett that we have looked at. The faster growing companies would be warranted a higher valuation. I think that's not necessarily disagreeable. What's becoming more challenging is you see companies like Apple as an example, which invented a number of products all within the last decade or so and had rapid growth. And of course the company value grew and grew and grew, but the valuation stayed pretty modest because the stance was, we believe that the stance was on Apple, is that the market didn't believe they could continue this innovation. That may yet to play out. But there are other areas of the market that are very attractive. We see a great opportunity in medicine as an example. We've noticed that there has been a significant shift from the chemical treatment of disease, if you will, to biology. And this is reflected in companies that are fairly young, but innovating new cures, if you will. Gilead is a good example for those of you that are familiar with that. They developed a cure for hepatitis C, which affects a lot of folks around the world. So there are opportunities there in healthcare. And also, there will be other innovations in information technology that are yet to be commercialized. We expect we will see those manifest. We don't know what companies they will necessarily be. And the valuations probably will be high. But when we look at the overall market and we make the comment that we see reasonable valuations, they're not just related to a growth rate, they're related to the other factors that will impact that growth rate.
In the back.
Your preference for more defensive companies, where do some locals like Procter & Gamble and Kroger fit in? Procter & Gamble's results yesterday seem to finally show maybe the beginnings of a turn. What are your thinking on those companies?
So good question. Some local companies, and what do we think about Procter and Kroger?
Well, Procter had, as you mentioned, announced results yesterday, and our observation of Procter & Gamble, particularly in these first few days of 2016, is the stock has acted in what we would consider the classic defensive way. They have products, obviously, that generally are not impacted by economic trends, although they would tell you currency's been a wind in their face. Procter & Gamble is still, in our view, they've got some work to do before they can turn around and show growth, and therefore see that reflected in their stock price. Kroger's another example. It tends not to be as sensitive to economic cycles or even a minor slowdown in the economy. Kroger also has exhibited over the last several years in our view, an extraordinary ability to compete in what is one of the toughest businesses that we know of in terms of profitability, but they are in fact defensive. And the same can be said for utilities as an example. We think those particular stocks in that industry is going to be defensive here in 2016. For Bill.
I tend to look at these things probably way too simply, but paying $1.49 for gas seems better than $2.99. And I don't think a recession's ever been caused by the price of oil going down, but going up instead. What do you mention? I think it was you said you expect to see oil moving up. Where do you think that's going to level out in terms of a kind of a medium term?
So our prediction on oil prices over the near term, coming up slowly, right?
Well, I hope you have a sense of humor. I don't think we know what the answer to that is. I think the consensus view is that at some point in the next year or two, it might settle into this $40 to $50 range, and it's recently been under 30, and I think it's around a little over 30 today. I think, is that your main question, is what will the price?
Actually, it sounds like if it does, that'll actually help the markets the way it seems to be going.
Well, it's really hard to say. The consumer hasn't really been spending they're sort of sitting on the savings, either because of anxiety about other things or they're paying down debt. But basically, there's kind of deferred spending out there because the money is there, the savings are there, it just hasn't been spent yet. But you know, it's really there's a lot of moving parts to knowing where the price settles. China accounts for a huge part of the incremental demand for oil, and now those estimates have been coming down. And so what happens in China has a lot to do with incremental demand. And then supply is a function of what's happening in Iran, in other countries, as well as whether the fracking companies really do reduce production. They've gotten extremely efficient. Terry talked about technology, but the extraction of oil has become a high-tech business with these new recovery techniques. So there's a lot of parts to it, but it does appear to us, if you look at it, that the supply of oil, the production of oil is starting to come down, and the demand is still going up. And after all, somebody has to feed all these SUVs that have been sold in the last year.
I think we have time for one last question.
Hello, you talked about how you have developed your strategies and tactics against these volatile markets and looking forward to 2016. One of those volatility components is the strong US dollar. So what is your view on where the dollar is headed? Are we going to hold against global currencies, drop, or continue to be strong? Because I'm sure that quite a few of the companies, you talked about Procter, you know, that affects them with bringing the dollars home, not so much Kroger, but there are a number of others out there, and how you are addressing that in your strategy and tactics.
Sure, good question. There's a lot of multinational companies that we hold in our portfolios that are impacted by the strong dollar. So how do we look at that? And I believe that was in Woody's presentation.
Well, the weakest part of the world economy is really in Europe or China or maybe Japan. And to the extent that we can sort of give them a little benefit from the strong dollar, hopefully that will kind of recycle back into the US market. But there's a lot of fragility in these other economies. And so I think there's a view that if they can benefit somewhat while they're kind of on the precipice of growth versus no growth, that maybe that could be the spark that gets their economies going, and then we'll eventually benefit from it. But it's certainly in the very short term, a strong dollar has a depressing effect on US manufacturing businesses. But over the long term, we think this will all work out. I mean, these cycles, we've been through these many, many times before, through long bull markets, and so we don't think it's a longer term concern. Did you want to add that?
Okay. Thanks for your questions. And we left the dessert out, so there's plenty of food and coffee and time for questions, and all of the advisors will be over there if you have some additional questions that you'd like to ask. While we barely touched on the noise, I think we just had one question about the what we expect to experience in terms of noise as a result of politics and the election going on this year. I'd like to announce that we will have Greg Valliere, who is a political consultant and insider, who will give us his perspective on the markets on May 18th. So there's information in your packets about Greg, and that you'll be receiving an invitation. We think that this is a good time to have him in. It'll be the day after the Kentucky Democratic primaries. It'll be in the thick of primary season, and probably the field will be narrowing down to fewer candidates by then. So it should be an exciting time, and answer all your other questions about what will politics do to the markets, and hopefully we'll have better markets by then. Last year we asked all of you what you valued most about Bartlett. There's this handout in your folder that lists numerous attributes, but I would like to point out 3 of which I think stand out as reasons for all of you to refer your friends, family, and colleagues to Bartlett. First, our investment management advice is complemented by expert financial planning. In October of 2015, Bartlett was named number 4 in the nation by Bloomberg News among registered investment advisory firms who also do financial planning. So that's a very high ranking for a firm here in Cincinnati. Secondly, Bartlett has time-tested experience that has guided generations of investors through world wars, the Great Depression, recession, and financial crises. And Bartlett is in its 118th year of doing business. And lastly, our community leadership and involvement. Through the years, Bartlett has built our legacy on community involvement, and that is valued by all of you, our clients. We have a 99% client retention rate, and we have a record number of clients who have joined Bartlett in just the last year. We know that when people encounter transitions in their lives, like retirement, inheritance, sale of a business, or sadly, a divorce, that they also review how they might plan for the future, and consequently, how they might look at what their investments are doing, and how they want their investments to be realigned. So we thank you for referring your family and friends to Bartlett, and we thank you for being long-term Bartlett clients, and we really value the relationship that we have with all of you. I thank you for coming today and hope that you all stay for some more questions and cookies and brownies afterwards. Thank you.